Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm your host, Guy Allard, and my co-host, Victor McClure. Say hello, Victor.
Hello. This is the flu-ridden CSI show today. We're both getting over the flu. If you're alive the last couple of weeks, you know somebody that's got the flu.
Either last week or they're getting it. Absolutely.
Oh, and I hate the older I get. I called the doctor. I said, "How long does this take to get rid of them?" They said, "How old are you?" I said, "I don't know, 54." And they said, "Longer than when you were 34." I go, "What do you mean by that?"
That's not what you told me.
I said 5 days to 2 weeks. And I was like, he goes, "Think about the long end if you're older." I'm like, oh.
I will tell you, depending what version you've gotten, and I had the flu as you did, the first 2 days were miserable. I did not sleep a wink, not a minute, for 48 hours. I can't tell you when that's happened.
No,
it's like college finals or something.
Yeah, it was terrible. So yeah, I was 5 days with a fever, so I was like, oh my gosh.
And Victor, what do you think? Lots of things are going on in the stock market. The Dow Jones, the S&P 500 are reaching new highs. Mm-hmm. You're seeing profits roll out of NASDAQ because the NASDAQ sector hasn't been performing as well. Mm-hmm. People also right now, I don't know if it's Bitcoin or what, but they're bolting out of the safe havens like utilities. They're going into financials. You got to always stay on top of things. We talk about rebalancing, and it's an active sport, isn't it?
Oh, yeah. I mean, what happens is everybody chases returns. Everybody chases returns.
Absolutely. Say that again. Everybody chases returns.
They always do, always will. The most inflows into the stock market every single time or before it crashed. It's always like that. They're going to pump it in because what happens is they'll sit in the sidelines for a while, and then all of a sudden it makes another 20%. Finally, like, damn it, I'm in.
That's right. And they jettison the safe stuff.
That's right.
That's crazy. But yeah.
Oh, that 1% of the bank was terrible, or 0.1, whatever. You got to get rid of that thing. But you still got to have common sense. You still have to reallocate your stuff. If you're 60 years old, you shouldn't be 80% stocks, 90% stocks. I don't care what the market's doing, because you have to protect yourself. If you would have rebalanced always, every time, throughout your entire life, you wouldn't have got the maximum return on everything, but you wouldn't have lost either.
And very few, and I'll editorialize, very few people get the maximum because they're not in the right spot all the time.
Well, I have people call me all the time that I wasn't getting any kind of return. The market's going like crazy. I'm not getting a return. And there could be a myriad of factors from that, because not every sector of the market has gone like crazy. Right? Certain sectors have. And what you'll find is the Dow Jones or the S&P, well, certain sectors like financials are leading those. So if you had more of that, you did better. Less of that, you did a little worse. And so it's really tough unless you have the actual index itself.
And we're here to help you, and that's what we want to do. And the reason to do it, obviously, we've been around for a long time. We've got a lot of experience. We're very good at what we do, and it's easy to show you that. But an ancillary benefit that you may not think of when you have an advisor, someone that doesn't charge you crazy fees, been in the business a long time. We talk about the psychology of investing a lot. And the one important thing that you may overlook that it does is it takes emotion out. We're not emotional about your accounts. As Victor says all the time from his engineering background, it's all about the math for us. And when you're involved in the flight to and from quality, as we're giving now for the from part, it's based on emotion.
I mean, that's what I've talked about. You've heard it on this show for many years. There's nothing wrong with managing your own money. The problem is taking emotion out of it, which is really, really difficult to do. I don't care how strong you are. Taking emotion out of your investment decision is very difficult, because it's like operating on yourself.
Selling winners and buying losers?
Yeah. Everybody does the same kind of things. It's human nature. Until human natures change or humans change, it's going to be very difficult to keep up. I've never seen a person consistently beat an index long term with all their money. What they'll do is they'll compartmentalize. They'll take this account that's done real well and like it's done for the entire allocation of their funds, when it was just one piece of that account. You'll compartmentalize your head. Look, I made 30% last year. Okay, if you had $1 million, you got $1.3 million now? Well, no, because I had some in cash. Well, so overall, this is what you make. That's what you got to look at is your overall all the time. And your main function is trying to beat inflation.
That's right.
It's not, somebody asked me and they said, well, why do you think people are in the stock market? I said, there's only one reason to be in the stock market, one reason only. It's the potential to beat a CD. Otherwise, you'd have everything in CDs, right?
That's right. And who do the people that have hundreds of millions of dollars, they're usually in tax-free munis.
A lot of times they are.
The majority of it. Or their own business.
Right. Especially politicians, because they don't mind taxing your income because
That's
they keep their income low.
That's right.
If their investment income, they don't want taxed.
That's right.
So they'll put it in munis a lot. And there's nothing wrong with municipals. They're just not paying much now. Well, I forgot. There's Merry Christmas to everybody. Christmas was last week.
Happy holidays to those of you that don't celebrate Christmas.
New Year's is this Sunday, so happy 2018 to everybody. My East Texas relatives came in for the holidays. This was the 4th successful year. There were no valuables missing, nothing. 4 years in a row.
Everybody kept the shirt on.
It's very successful. And like I said, we'll start, new shows next week. This is the last show for 2017. So I thought we would talk about the tax bill that got fast-tracked. Remember, Trump was talking about signing it potentially in February, I think,
yeah,
to make certain things like the Medicare cuts and all that kind of stuff wouldn't come into effect.
But to keep his promise, he wanted to go ahead and instead of using it for political capital, which would have been to his advantage to do in January, he went ahead and knocked it out. If you want, I've got a question. I've talked to a couple of accountants that have made some suggestions, and the Mayor de Blasio up in New York, of course, that's a state income tax state, is doing it towards state taxes. But here, they've been talking about prepaying your 2018 property tax if you do it by January 15th, I believe, so that you could take, you don't get the cap. So obviously if you had a real big house and you got a lot of property tax, they're talking about, and you need to talk to your accountant and make sure that it's right for your situation. But and they're certainly saying if you owe property tax for 17, that's going to get dinged. You want to pay that on time because if you delay that, now you're under the new rules. But what do you think about the prepaying of the 2018 property tax to get under the wire?
If you have a whole bunch of property tax, it might be worth it. You got to make sure now that some municipalities, it's up to them whether they accept it or not.
They're right.
So you got to check that. Some of them will not accept it because you're prepaying for next year.
And if you're in New York and you're one of these big condo conglomerates, it's a conglomerate of everyone's taxes. You can't just do it on your own. So there are some exceptions.
Right. So it makes sense for some people. Like I'm in Prosper and we pay ridiculous taxes.
Until it gets built out, hopefully it'll come down. Right? Didn't they say it'll come down once we get built out?
Well, they did in Frisco. I remember in Frisco they were building before they had any infrastructure. Like
did they actually lower it though?
They did. The percentage. Since they
Significantly?
raised the value, your payment never goes down.
Oh, that's right. That's right.
It's always just the percentage. I've never had a tax bill go down in my life.
That's right. No.
They just slowed down the gain or something like that.
Wasn't income tax a temporary provision anyway during the war?
Oh, I think a long time ago.
Oh, yeah.
But we'll talk about we'll talk 10 of them. There's a lot of things that would take you a long time to go over every single thing, but the main parts we'll talk about and what changes because this is talking about your money. Remember, if you have any financial questions ever, if you'd like to take advantage of our no-cost, no-obligation written retirement plan, don't hesitate to call us at 972. Oh, gosh, 960. What's our dang? 715-2424. Sorry, I've got the flu, and I forgot the number I've used for 30 years.
I don't know how it comes across on the podcast or on the show, but I can, sitting in the studio with you, I can tell your voice is having a hard time.
So it's 972-715-2424. You can always go to ilovemyretirement.com. Why did we call it ilovemyretirement.com? Because when all your bills are paid until you die, you have a great retirement. There's a difference. I can't tell you what a great and good retirement is. I can tell you financially, knowing my bills are paid till I die, no matter what the stock market does, that's a great retirement financially. Hopefully you'll find some hobbies or whatever. I don't have any hobbies hardly. I do a little shooting here and there, a little fishing. Everything else is pretty much I'm going to work till I die. So that's the way it is. All right. Individual tax brackets. They have changed. They've gone down.
Still have 7 though, correct?
Yes. That going down to what, 3?
Yeah.
That was the Senate plan. I think they went back to the House plan, whatever. But for some people, it's lowered, especially in the lower income brackets. For some people, it's raised. If you make between 200 and 500, you could have now go from like a 33 to a 35% instead of the opposite. And so they start 10% tax bracket. Remember, you used to have a 0 tax bracket. Now they start with a 10, but it doesn't start till 19,000. And remember, you've doubled your standard exemption. Standard exemption goes up. I think it's 12,000. Now it's 24 or whatever. But you can't write off your individual dependents. Remember that 40? I think it was 4150 each.
Yep.
So if you got a whole lot of kids like I got, not that it matters. I've always been to the AMT. We'll talk about that later. I couldn't write off anything anyway. But for a lot of people, you just have to do your taxes and kind of see if it's going to benefit you. But I think most people making under probably 200,000 will definitely benefit you, and people making over say $1 million.
And the stimulus and again the peripheral things should help. More people should be employed. The economy should do well. Those things will help.
I was asked a lot. I'm not an accountant. We're just reporting this. But some people say, why are they going to go back in 2026? Well, I think that was a Senate deal. Unless you get 60 votes, it can't be permanent. So they only got 51 or whatever, 52. Right?
That's right.
So I think that was the reason. It wasn't because they're trying to get cute. It's because they knew no way in hell we're going to get 60 votes.
Unless they change that law, while they could.
Now, they could change certain
Just
ones,
saying.
but to make certain tax laws permanent, they had to have that 60. So they said, well, let's just have it till then. Then hopefully cooler heads will prevail before 2026.
Oh, that'll happen.
Because it'll be an immediate tax increase to everybody, right? But the brackets are now 10 to 37. They used to be 0 to 39.5. Okay?
And keep in mind, I was talking with a client the other day. I mean, 55-year-old sharp guy, and the reason I preface it is because it's normal not to understand if you don't deal with it every day. If you do, then that's fine. But you're only, everyone talks about not wanting to get in that next tax bracket above them, and you hear people using write-offs to stay in the lower tax bracket. Your money is taxed in each of the brackets as you pass through. In the 10% bracket, when you're in that deal, that money is taxed at 10%.
That's right.
When you go to the next bracket, that money is taxed at that bracket. So it's incremental. It's only the amount over X amount that gets taxed in the big bracket. So if you're in the 37.5% bracket, all of your money isn't taxed there. You've paid each bracket as you've gone through for that portion of money.
You know what that's called is your effective tax rate.
Exactly.
So if you actually pay an effective tax rate of 37, you make a lot of money. Because you've already ignored all the other stuff.
Yeah, you've averaged all that stuff up.
That's right. The one thing for your investments, nothing's changed on the long-term capital gains and dividends. Well, that's a good thing. Because remember, you had the 15% tax bracket for long-term capital gains. We're doing everything joint. All right? It starts at $77,000 a year. If you make under $77,000, you have 0 long-term capital gains on your investments. More than $77,000, they have the 15% tax bracket, and that lasts all the way until you make $479,000. At $479,000, all of your investments, long-term capital gains, will be 20%. If you remember back in the day, remember short-term were full tax bracket, and they were a lot higher. So they were going to have a FIFO, which is, I don't want to get into it too much, but that's first in, first out. Make people start spending money out of their tax deferred accounts, but they got rid of that. Remember, higher standard deduction. All right? It's $12,000 for single, $24,000. So your first $24,000 is not taxable. Used to be they had 12, but you could take off $4,150 for each dependent.
That's right.
You cannot take off the dependents anymore. So in the old days, if you had 4 kids, you're going to take off
16.
That's right. Your $12,000 plus another 16. Well, you can't do that anymore. So you'll be stuck at the 24. Okay. Of course, it's different for singles and different for head of the households and married filing separately.
Yeah, we don't want to bore you with every little intricacy.
There's new deductions on state and local taxes. Remember, in Texas, we don't have state taxes.
But we pay for it dearly through property taxes.
That's right.
Just saying.
Our property taxes are probably double what most states are that have income tax.
Right.
I was trying to look at California. You have $1 million house and you might pay $2,000 a year in property taxes.
Yep.
We would pay, $20,000 a year, but we don't have the state income tax.
I don't know, not to sidetrack. I don't know how long these will be in effect, if they'll get repealed, if you get another administration, and all of that stuff. But assuming that this stays for a while, and like Reagan, it's not just one tax bill. Usually there's a second and a third, right? They come in and try to finish the job. I just wonder, the states that, we'll just say, maybe don't handle the money properly, that have these huge state tax bills, now that they're losing this write-off, do you think there'll be an exodus?
I think there's been an exodus from those particular states for a long time, and I think it will continue.
But I think the people that are leaving are replaced with people that they're being replaced by people as well.
We'll go where the jobs are.
That's true.
So if the jobs are there, they're there. The one thing about it, the high tax states have been able to raise taxes at will.
Oh, man.
They have a liberal policy, and they raise them at will because it just comes off of somebody's federal tax.
Not
so that
really
costs
taxing
the government
That's right.
money. I heard one argument that said, well, we're positive. We're still positive.
That's
I
right.
go, well, isn't everybody supposed to be positive? Everybody's supposed to pay in the federal government. Why would you pay less because you're a high tax state?
That's right.
So now they can't do that. So it's going to be real tough to make ends meet with some of those things because they're going to get squall. People squall and say, hey, why are you doing so much taxes here? When they never did before because it was a write-off. Well, now it's $10,000. It's only $10,000 that you can write off. Now, you and I are pretty much a consumer guys. We spend more than that in sales tax every year, don't we?
I'm not admitting to anything.
Besides my $20,000 on the dang property tax and everything else.
Honey, don't listen to him.
I did it one year where I looked at my sales tax. I was like, holy crap.
Oh, yeah.
It's not good.
We're not going to do that anymore, are we?
No. So that's what you've got there. Now, also, people wrote off the property taxes in their vacation homes. All that's gone. So if you pay a lot of property tax or state income tax, you cannot write it off anymore. You can only do up to $10,000. And what we're talking about before is a lot of people are trying to prepay because in 2017 it's still good.
That's right.
It's unlimited write-offs for state, local income tax. But 2018, it is gone. There are new limits on how much of a mortgage you can write off the interest from. It was $1 million for married filing jointly. It'll be $750 now. Now, most of the audience out there, most people don't have a mortgage that's $750 to $1 million. That's a mortgage.
Yeah, not the value.
So most people don't have a mortgage that high, so it never really affected you. But it will affect some people. You can still write off the mortgage. They were trying to get rid of that completely. But that one went through the, here, let me give you this. The holdouts always seem to, in Congress and Senate, always seem to get all the stuff, don't they?
Well, it was Rubio, wasn't it? They got the child care doubled and all that stuff. So. And
selling homes, none of that changed. Remember, it's up to $500,000 if you're married, and gain
5 years.
Yep. That's not changed. I thought for sure that was going to change too, but it didn't. Now here's
Thank goodness.
I know. Here's something that your medical expenses. Medical expenses, they used to be 7.5%. If your medical expenses exceed 7.5% of your adjusted gross income, then you can write it off the balance. Then it went to 10%. Well, it went back to 7.5%. So, and this is for the 7.5%, by the way, was retroactive to 2017. One of the only things that I know here was retroactive. So this year, if you paid more than 7.5% instead of 10% of your income in medical expenses, you can write those off. I thought that was going to go.
You pay, meaning out of pocket.
That's right. And if you have 1 million kids like I do, I just looked at it with the premium for the insurance, which is like $2,000 a month, plus all the co-pays. I end up paying like $29,000 with insurance. $29,000 in co-pays and crap like that.
You've got 3 kids, and I know it's expensive, and it seems like a lot. But man, was hearing some stories, and they were talking about having 7 kids in the family and 8 kids in the family, and I don't know how you could do it.
Oh, I know. No, it gets tough. Now, remember, you can't write off those individual deductions either.
That's right.
The people that used to be write off the first 100,000 because they got 7, 8 kids, you only had to 24,000.
That's right.
So that's a real thing that could really affect people with a lot of children. So you got to be careful with that. If you don't make a lot of money, if you're a family of 8, but you only make 30, 40,000, they're going to give you the first 24. and then you got all this. So it's still not going to be that bad on tax.
No, at all.
But you're not. A lot of those people didn't pay any federal taxes and get back 10 or 15 grand. That could stop. All right. Education tax were preserved. Your American Opportunity Higher Education Tax Credit worth $2,500, or lifetime higher education earning tax credit worth $2,000. That's still going. You're still good. No changes there. Starting next year, you cannot reverse a Roth conversion. Used to, let's say you did an IRA or to a Roth.
Right. Converted. Paid your taxes.
That's paid your taxes.
Now it's all tax free.
You could reverse it by October 15th if you made a mistake. Which, trust me, a lot of people convert Roth shouldn't have converted them.
Yeah, they weren't in a high enough tax bracket, in my opinion, to
remember to do a Roth conversion to make it mathematically work for you. You have to be in a high tax bracket and a high tax bracket after you retire too.
Because if you convert it, right, all of that is income that year, so you are in the high tax bracket.
That's right.
And if you're going to be in a smaller tax bracket in retirement, you just paid a whole lot you didn't need to.
So you could pay 35%, right now.
Right.
Or you might be in a 10% tax bracket in retirement.
That's right.
So you're taking out 90% of that deduction out of your IRAs or 401ks. You're only paying 10% taxes. Yeah. And that's where most people are, because when the paycheck stops, your income obviously goes down, right?
Yeah. That's right.
But people do it all the time because they're afraid of the taxes. They're afraid of it.
They love the word tax-free.
That's right. Tax-free sounds fantastic.
It does sound. It is fantastic.
And remember, it doesn't matter if it's tax-free or taxable. What is the after-tax equivalent? And if it's more money paying the tax, it's not. You shouldn't do a Roth. Be very careful. Call us. If you have any questions on whether to convert one, give us a call. It's not just your accountant. They're going to tell you the taxes you owe. We're going to tell you the ramifications of that. 972-715-2424. 972-715-2424.
And I would add, the best way to get tax-free income, in my humble opinion, I won't say the best way, but some good ways are, if you are going to be in a high tax bracket, then convert that to a Roth, because then now it's tax-free and a lot of benefits. If you're young, let's say late 30s, mid 40s, and you've got a substantial amount of money, and you could take out a 5-pay life insurance where you can put $100,000 or $200,000 a year or $50,000 a year away for 5 or 6 years, and then stop paying on it. By the time you're 60, the amount of tax-free income that you can take out each year is crazy high.
Oh, yeah.
Those are two great examples where you can really take advantage of it.
Right. There's everybody tries to fit everybody in the same box. If you're younger, there's certain ways to do your finances.
Right.
As you get older, there's other ways to do your finances.
Absolutely.
There's never a one-size-fits-all. There's not one annuity that works for everybody, one mutual fund,
or one
anything.
Indice that you need to
That's
put your
right.
money in.
Everybody has to do this index.
That's right.
That is all not true. The one thing they said they're getting rid of, and they promised they're going to get rid of, well, the two things. The death tax, which they did get rid of. They doubled it.
And what about the flow-through? Well,
yeah, pass-through they did, right? But the AMT, they didn't get rid of the AMT, but they did raise it. It was originally designed in the 60s, the alternative minimum tax. It's basically to get millionaires to not do so many write-offs where they didn't pay any federal taxes. And so they said $200,000 a year is what they're going for, even though it was $150,000. But if you're doing a regular versus, it doesn't really affect you to about $200,000. And so they're saying, think about it. In 1960-something, how much was $200,000 a year in income?
Oh, crazy.
Huge amounts of
money.
money.
If you had $50,000 a year, you'd plan on that would be enough to retire on forever.
So I remember in the 80s, I just said, if I save $1 million, I'll be rich. Or if I make $100,000 a year, I'll be rich. In the 80s, you were pretty well off.
Absolutely.
Right?
And now, the interest that we were talking about on the hedge fund guys that didn't get done, they were going to carried interest. Mm-hmm. They were going to take care of, and they didn't.
They did. So now, though, it's at $1 million if you're married filing jointly before that kind of stuff kicks in. There's an AMT exemption amount, the first part, but it's not, but it's all the way to $1 million. So it should not catch you unless you make over $1 million. Then it catches you again. They promise
if you make over $1 million, God bless you.
Then my dad always said that. They said, "Oh, you pay too many taxes. Oh, that's a high-class problem, boy." I go, "No, I pay half my damn check in taxes." He goes, "Oh, I'm so sorry for you."
Right.
I was like, "Well, he's not a good person to do it." So remember, AMTs, that's what it is.
Alternative minimum tax.
Another thing, remember when you used to let's say you got your house burglarized. You're going to write off those losses? Not anymore. Only can write off casualty and theft losses if it's a federally declared disaster like the flooding down in Houston. So somebody robbing your joint, you can't write that off. That kind of stinks, right? Next year, moving expenses and most miscellaneous itemized, they're gone.
Oh, wow.
Can't write off a move. Usually you can only write it off if you move more than like 50 miles from work, something like that. Yeah. But now you cannot. Adoption expenses, you can still write that off. Let's say plug-in vehicles, if you want them, they still got that $7,500 tax credit for a new electric vehicle. That's still there.
Ah.
They had it for golf carts, but they got rid of it.
Elon Musk is very appreciative. Oh, I heard, sidetracking, I heard he's got a pickup they're coming out with next year. Anyway,
oh, really?
Yeah, enough said. Yeah.
Next year, your unified federal gift and estate tax exemption will double from $11 million to $22 million for a married couple. So that's a good tax break if you have $22 million. All right, so those are the kind of things that are doing it.
I'm hoping that'll be a problem.
Right. That's our tax things. College planning. The 529 plans you can now use for pre-K, kindergarten. It used to be had to be for higher education.
That's right.
It is not anymore. They've got rid of that. Let's see. Estate tax has gone from $11 million per person, or it was gone from about $5.5 million
to 11.
To 11. So if you're a couple, you get $22 million will not be covered in estate tax. You'd think that doesn't catch many people, but sometimes they have a business they've had for a long time, even though they don't have that much in cash. The business is worth that, and that's the taxes. So they promised they were getting rid of that one. That was in both versions. Somehow it jumped back in. Didn't you? Won the Senate and the Congress.
Yeah.
It's gone. It's gone. Somehow it got back. So if you're doing estate tax, let's say you've done some estate planning, you just need to adjust it because it's still going to be viable unless you have a business that's worth, say, 10, 12, 15 million. Then right now you're okay. And I believe that one is permanent. That doesn't go back to the 26.
And the problem is when it's all hard assets. If you had $100 million apartment building or something that was all hard assets, and your kids get it,
right?
They got to pay taxes on $80 million of that.
It's like a 40%, 35% taxes. So how are they going to come up with $350 million on a building?
So they have to either mortgage it or sell it to pay the taxes.
And we understand fully that's a high class problem, and you don't have much sympathy for somebody that gave. Oh no, they received $100 million.
No tears out there.
And they had to get $35 million of it back. I get it.
Yeah, that's right.
But it's honestly, it was more for like people with small businesses, farms. Because you see some of the real estate's gone up so much, they might have bought this 1,000 acres in East Texas for $5,000. I've actually have clients.
Yeah.
They bought the whole thing for $5,000. It's worth $3-4 million.
Oh yeah, and the taxes on that kill them too, unless they have some ag exempt or something going on for them.
And so they got to do all of that kind of stuff. So that's what it is. We want to wish everybody a happy New Year that's coming on this Sunday night.
Hope that helped a little bit on the taxes.
Hopefully, we probably confused them more.
I would think.
But there is a lot of beneficial things, and it just depends on how much money you make, whether you're going to be in a higher or lower. I think for most people, it's the in-between guys, and they're saying about between 200 and 400, which, believe it or not, in the suburbs or Plano, Frisco, Prosper, that's where a lot of people make when they put their family together, right? Those could be, they could go either way. It could be higher taxes. It's probably not going to be lower.
So are you saying stay under 2 or get over 4?
Yeah. Well, they said it's actually over $1 million is when it starts because they don't have that extra 2% on the tax bracket thing. I want to thank everybody for listening. Remember, if you'd like to take advantage of our no cost, no obligation retirement plan, stress test, Social Security optimization, don't hesitate to call our hotline, 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. We want to thank everybody for listening for all of 2017 since our last show. We will see you in 2018.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.